Welcome to Fortune Prime Global, a rapidly growing and award-winning broker. FPG has been operating for over 10 years with multi-regulation. Connects its clients with first-tier trading liquidity providers, thus offering extremely low spreads.
Obviously, the goal here is to improve on your technical skills, analytical skills, and to try to cut away and remove the clutter. You know, I still have a close friend. I have a boys, typically, as many people do, I have a WhatsApp group that I'm a part of, and they are still very much of the belief that gold is a hedge against inflation, and that's an urban myth. That definitely tonight, if there's one thing I want you to take away from this, is that gold is not a hedge against inflation. It may have been at some point in the past, but it certainly isn't the case in the modern financial markets. And this is something we know because we've recently, over the last 2-3 years post-COVID, as well as since 2022, when Russia invaded Ukraine, we had the greatest sort of united sort of global inflationary period that we've had in many years. And during that period, we can actually see, when we look at the charts in front, for example, we can see that gold was actually declining during that period. So, and really a lot of that had to do with the US dollar. So it had, you know, if we go and have a look, for example, excuse me, I always have to remember where the clear drawings tool is. But if we go, and I'm going to move it up here as well, so I have it up at the top of my screen. And then if we go ahead, for example, and compare that to, say, euro dollar, we can see for that exact same period, we can see that the euro declined at that same time as well. It was the same thing. We saw a very strong dollar. If we go ahead and have a look at sterling, we can see sterling at the same point as well, also having a very strong decline. We go look at Aussie dollar, US dollar, we see a similar type of decline. If we go ahead, for example, and have a look at, say, Apple, we can see same thing again. Oh, okay, that data is not looking that good. Let's see if I can find another one here. All right, you know what we'll do? We'll take the Dow. So the Dow during that same period as well, and the S&P and the NASDAQ as well, all had that strong period where the dollar basically took control and pushed everything back. So one of the things that we often forget is that of all the different asset classes we have, for example, we have the commodities, we have indices, and we have currencies, that the US dollar is actually present in all of them. So the US dollar is available in commodities as well as the global markets, as well as currencies. But not all the currencies are necessarily available in all those different markets. What does it mean? It means that the dollar itself, not only is it the biggest currency within the currency market, but it's also the biggest currency within all the other asset classes as well. Globally, the US dollar is used in about 90% of all the transactions on the planet. So what happened in recent years was that we had a really strong dollar when we had a stressful period. We had inflation, and there was a fear of war came out, and there was supply chain issues and all kinds of things. And so there was panic, and we had inflation. And at no point during that period did gold get stronger. It got whacked, it got knocked down. It wasn't even on anyone's mind at all. So that's the very first thing we have to do. We have to remove the false ideas that can get stuck around gold. And I want to give you a little bit of history on gold from personal experience. So if I go back to when I was getting into trading, it would be somewhere around about this period here. And we can see that at this time, gold had a little bit of a breakout. Let's actually, what I want to do here is just quickly edit this. So we won't do that as array. So I can draw these as separate lines. And so we can see it was around about this period, gold was breaking, and it was just generally had been ticking along for a very long period of time. So at that time, very small retail market of trading, and it's just grown so much since then. So the point is that over the next couple of years, going all the way up to the all-time sort of highs over here, we could see that over 2011, sort of 2.5 years, the market just continued to tick up, and you could almost do no wrong. Gold was just always going up, and that set in place this idea that gold will always go up. So this is, you know, for many people who are watching this, you might not even have been in the game back then. But back then, that did kind of set the expectation that up until that time, gold had always gone up. It really had, or at least on all the recorded history. And certainly over the last 2.5 years, it had just continued to tick up very steadily and then started to gain pace in the last couple of months. And what this did was this created this frenzy. So this was a pure bubble, and it's important to understand, you have to go through at least one bubble in your life. You have to experience at least one market bubble as a trader so that you can understand how in the moment you can be absolutely 110% convinced that this is how things are going to be, and that this time it's different, that this gold bubble is never going to come back down, that property prices are never going to come back down. That's the 2007, 2009 global financial crisis. That Bitcoin is never going to come back down during the first crypto bubble. Then Bitcoin's never going to come back down during the second crypto bubble. And then, of course, Tesla's never going to come back down during the first Tesla bubble. It just happens over and over and over again. You really need to see it to really learn the lesson that nothing is bulletproof. But the biggest one, of course, is gold. If gold, which is our oldest currency going back 10,000 years, if gold can have a bubble and burst and come back down and lose favor with everyone, then so can anything, actually. So during this period, we see gold started to peak at around about that 1900 level, give or take 1900 level. And at that time, it was absolutely insane. You're getting all these PDFs and speakers. People were having these seminars about how gold and silver, now is the time to buy. People selling physical bullion. There were all kinds of scams going on. I mean, these things happen in a bubble. So it's very familiar if you've lived through any other kind of bubble. And then what happened was it started to kind of collapse a little bit, came down, tested the lows down here, tested these lows over here, and then tried to go up again. It became a bit range bound. So there's a little bit of a range. Let's just talk about that. Little bit of a range there. I just want to make this a little bit darker so it doesn't have to be quite this. Was it this one, or is it a little bit something like that? Okay, it's a little bit darker. Got stuck in this range up at the top and the bottom, and eventually broke out. And that period of time from September 2011 until it broke through, then becomes, where's my, I don't have my dates on that one, so let's just bring another one in, until then becomes April 2013. That's, going to be not just the next year, but the next year. So that's a while later. It eventually breaks down, and it drops a significant amount. Okay, let's just move it. I just want to check that I got that, so that's fine. Drops a significant low, and then actually proceeds to continue down in a little bit of a downtrend over here before it breaks up, and then encounters a very, very, very strong level of resistance in this area. So I'm just going to adjust this. I want to make sure that I get this kind of right. Roughly in this area, which is roughly 1330, give or take. I know this because those numbers, you sort of start to learn all about them. So it stays below that. So let's just recap what's happened. The bubble, market thinks it just is never going to stop. It fails. It takes about 18 months to 2 years, almost what feels like almost the third year later. So it's the next year, but the next year later, it breaks through a low. Then it continues to drop, and it proceeds to continue to go down to 2015, December 2015. So look at that. It kind of tops out end of 2011. By 2015, now what's happened is people don't understand what's going on with gold. It's continued to drop for several years, and then it eventually starts to bottom out, starts to work its way back up, eventually encounters a level of resistance and stays in that area until it finally breaks out in 2019-06. So it stayed below this level that it just was unable to get above. It stays in that area for 5 years. Okay, so actually 6 years, I beg your pardon, actually 6 years. So, excuse me, so it stays there for 6 years. That's a very long time. And at that time, everybody started to look at cryptos. They've started to look at other things. They're distracted by other things, and they've got bored of gold. These are all very important descriptions because these types of behaviors will happen everywhere in any market over time. So this is not going to be the first time you're going to see this. It's going to happen again in other areas. But the reason I also wanted to mention this is if we look at a Fibonacci retracement, so the biggest move prior, this would be the biggest low we had, the most recent low, going up to those all-time highs, you can actually see that it approached the 50 and a 618. Effectively, I'm going to argue that it stopped at the 618, just dipped below that, but 618 was actually its retracement. So why does that matter? It matters because no matter how bullish a market is, so if a market is trending and then spikes up, it can have a 618 or a 50 fib retracement, and then it can recover. And this could be the same for Tesla, for example, or for Bitcoin, for different markets. So it's important to get some sense of how much that correction was. That correction, although for a lot of people living through it in those years, if you're not looking at the monthly, you tend to lose perspective. You tend not to get a sense of it. But if you were checking the monthly on a regular basis, you'd have realized that we've approached the 618 level, and that if it was going to turn around, this was the place to do it. Okay, and eventually it became clear that you can see it sort of testing support here, and then it becomes range bound in this very small area. That's a very cool little thing that I've never seen before. I've just seen this now while I've drawn that just during this period from there to there, it actually was range bound, ping-ponging between these levels, broke out of the range. And what I also would like you to see is this little area here where before it moved, pulled back a little bit, produced a bullish candle and broke out, because there's a lot of markets that are kind of producing this exact same pattern right now where they're in a range and they've just pulled back, produced a bullish candle. Just very quickly to give you an example of that, I've seen about 5 or 6, but the one that's off the top of my mind here would be the weekly chart here. And it's also range bound, just so you can learn the pattern and move the pattern up a bit. And you can actually see, if you zoom out, we've just had exactly the same thing. We've had stuck within a range, pulled back, and it's starting to break out. Even today, even this week is starting to break out of that. There's a lot of different patterns I've seen like that. So let's go back to gold. So what have we learned so far? We've learned that it went through a bubble. We've learned that eventually that bubble popped. It came down. It took a very long time. It took years to recover. That's something I want you to remember. You could be in this game. Hopefully you're in this game for the next 15, 20 years. And you could pick something that you think is this is the problem of thinking that something is bulletproof. I know people who are Tesla bulls, and they go, well, it doesn't matter. We're thinking long term now. Tesla's going to be fine in a year or two. But the reality is, I'm not saying it will, I'm saying the reality is that the possibility exists that Tesla, for example, could be in a slump for the next 10 years before it recovers. That's a possibility. Your brain has to just at least consider the possibilities that it sometimes doesn't. You know, it's even possible that when we look at something, for example, the S&P. So if we go over here and we look at the S&P, which is performing really, really well, we could, in theory, this is just to belabor that point, we could still have a point in the future where for 3 or 4 years, the markets just go sideways. They don't always necessarily have to go up. It could happen. And we need to just be prepared for that. Our brains have to conceive of that as something that could happen. Okay, so, whoopsie, there we go. So let's go back to this. So the next thing is price eventually breaks out of that consolidation. And one of the things that happens when a market is consolidated for a long time is that once it's broken out of it, it runs. It's basically it's been resting, it's been in a bit of a coma. Once it breaks out, it really just wants to go. And so at this point, this thing breaks out and runs. And the most important thing that happens, and I'm getting rid of the Fibonacci thing here, is the most important thing that happens is it immediately breaks and goes to a new high. So you go from this high over here to this high up here. You get a brand new high. That makes sense because finally gold is, generally speaking, is maintaining new highs. And actually you can also argue that you could draw a trend line from here almost sort of like that. It's not a great trend line, I grant you that, but it's something like this. So let's just put it there. Something like that. It gives us a general idea of the way in which gold is flowing. Then it takes a bit of a breather. It comes back. So now we can start to zoom in on this. It takes a bit of a breather, finds a little bit of an area of support over here, and attempts to take another run, and then of course creates a fresh high. So it goes from here, creates a slightly, well, equal high. And this is where it's a bit of a problem. So one of the things that happens is seasoned traders who've been trading for decades know that usually when you get to an old high that you haven't been at for a while, usually what happens most of the time is that the very first thing that happens is that when a price reaches a level it hasn't been at in quite a while, there's and especially after it's been running all the way up, so it's been running and running and running and running, it's quite tired, and then it gets to a level that it hasn't been at for a while, then usually at that point there's a sell-off. So there's a sell-off because in the run-up to do it, the people that are making profit want to take profit. So their final target to take profit is the old level. So they look to start taking profit and extricate and exit those positions. And other traders know that they're going to do that, so they start waiting at that side and they start selling. So often you get at least an initial sell-off. It doesn't mean it's going to be a massive one, but you'll get some kind of a sell-off in that area. Then what happens is price is going to take a bit of a breather. People have taken their profit. They now want to take another run at it. And this is where it gets interesting. It could potentially continue through without having a reaction. But if it has a second reaction, that sell-off is bigger. So actually at this time, nobody really knew. In the moment, nobody really knew for sure ahead of that sell-off that it was going to have another rejection. They didn't know that. But as it was rejecting, then all of a sudden, shorter-term traders started to realize, okay, this is going to be a bigger reaction, and a second reaction is actually, it's almost like a second failure. So when you have a first failure, it's normal because you're taking profits and you're having a bit of a rest. A second failure is a bit scary, so then you have a bit of a bigger sell-off. But while all that's happening, gold is actually resting because it's been moving up and it's taking a breather and it's taking a breather. So it's still building up. Although it isn't continuing to trend, it's actually building up a little bit of energy. So it recovers from this, comes back up, creates another new high, and there's a third sell-off. Okay, but there's a thing now. So what happens on the third sell-off? Does that now not create more panic? Well, in this particular case, what has become clear is that price is continually wanting to go higher. So although it created a new low, it actually went and created a new high. So it actually, so what it does then is creates the impression clearly the markets are wanting to continue up. So then you get a slightly higher low, and this one in particular was a big clue, ladies and gentlemen. This one was a big clue. This was a bullish engulfing candle. Let's just quickly do this, make it as big as possible. There we go. So this one in particular was a big clue because it was a big bullish engulfing candle. Excuse me. So that was a big bullish engulfing candle, which is a very strong sign of bullishness. So what I like as a trader is that as you follow the story as it's unfolding, whether you're following it on a weekly time frame or a daily time frame, it is telling you, it's in real time, it's communicating to you how it feels. And so it's doing both. It's kind of telling you brand new data, but it's also often giving you that data in relation to recent performance. So this bullish candle, when you look at it in the context of all the stuff that's gone on here, it's not a sign of weakness. It's definitely a sign of strength. And then it attempted to continue, and then there was another little bit of a failure. So what we've had, though, in theory is or not in theory, we can see it, is a series of higher highs, and especially, and I think this is important, a series of higher lows here. So currently, when we look at the most recent thing for price, we're getting a series of high lows, high highs. We are bullish, we are trending higher. And then what we need to do is get a sense of what are the major levels. So if you take everything off your chart, ladies and gentlemen, if you take everything off your chart, we can do it with anything. Let me go and do this one. And let's change what we're looking at. So it looks like this. So you don't even have candlesticks, you just have price. And so when you're looking at price, at the end of the day, that is just price over time. But price itself is one of the most important elements that we need to pay attention to. So both fundamental traders and technical traders consider price to be obviously crucial. So fundamental investors and analysts always say, well, I think gold is cheap at this price, or it's expensive at that price, or I would sell it at this price, buy it at this price. And once you see over time the orders going in, because this is the beauty of technical analysis, is that the chart represents the actual physical orders going in. It's not a rumor. This is not Warren Buffett buying this, or Elon Musk is selling gold, or some kind of a rumor, JP Morgan or Citibank type of article, that rumor mill stuff. There's a lot of that junk out there. This is actual physical orders going through. And you can see where the orders have started to pick up and whether they're very bullish or very bearish. You can tell when price gets to a particular level and maybe you get a particularly bearish reaction to that, a candlestick that reacts like that. That tells you it's almost like an allergic reaction that price has to that level. So price levels are the most significant indicators or tools or drawings that we have on our chart. So horizontal levels is the number one number one, off a blank chart, you would start with what are the most significant prices that I need to pay attention to. Then when you add on candlesticks, then you get additional information. You can see in this particular case that the market was very bullish and just drove its way through that level, that price level, and then continued on. So when we look at the story now,
lovely.
we can see.
Yeah.
Everyone okay?
Yep. Would you like to share something with us? Also, Adam, by the way, could you just attach, just show a moving average of 200 periods in gold?
Sure.
That would be great.
I was going to get to moving averages, but let's just do it now then. Okay, fine. So we'll do 200. We'll just do a standard one, normal, traditional type of thing. We'll just do that. And there we go.
Oh, okay.
This is on the, this would be on the weekly. Just making sure we got that. So this is kind of how that story works out really well. We get a really nice bullish reaction there. We get a series. If you look now, we've got a low, higher low, higher low, higher low, and we've got higher highs. So generally, again, we're just pushing that a little bit higher. And so again, it's important, I think, to have some history behind. I want to sort of convey to you all the things that we've seen that price has done, plus some concepts. I want to make sure you understand that gold can go up or down if it's in demand. So why would gold be in demand? Well, we use it in technology. It's used in satellites. It's used in jewelry. It's obviously used in jewelry, obviously. It's used in, well, people buy gold and store it as a form of wealth. So, and countries, central banks have to hold gold as well. And then you have it in our cell phones. It's everywhere. It's in technology. It's used in cars. It's all over the place. So people have to understand gold is used in our daily lives on a regular basis. All right. Now, one of the things that we can see, especially when we look at it, is, and this is why I wanted to go to the monthly time frame, is to get a sense of where are these key levels. So also want to get rid of those horizontal levels. Let's go through to gold and have a look at it. I beg your pardon, because we weren't looking at gold there. We were looking at another one. So let's bring in the moving average, the 200 for gold. Okay, there's your 200 for gold. And again, let's just get a little bit more of that history there. Doesn't really give us a lot on the daily, and on the weekly it does. There we go. So, okay, so now we want to get a sense of where are these horizontal levels. Let's start with that. And I think what I'm going to do now is I'm going to clear up all the, or I'll just do it on a different chart. Now I'll do this. I'm going to remove all the little bits and pieces. So just clean the chart. And now let's look at where we're at. So let's start at the all-time highs that are over here. You can see as we go through this, that price had a reaction there, and actually a bit of a reaction there, tested a support there. Okay, and then we can see if we come in again, you can see a strong reaction at these levels over here, there. And as you're drawing horizontal levels, usually what you want to try to do is to connect as many dots as possible. You want to draw a line that connects as many points. That's usually a significant, that's how you're highlighting a price that's obviously significant. I'm just keeping an eye on the time. So we have about 15 minutes left, and we wrap up at about 38 minutes. And I don't want everyone to be surprised when suddenly if the webinar ends, because it's just a short Zoom session. And then we'll take any questions. Obviously, just ask the questions as you go. And then what we'll do is we'll potentially just upload that recording if you want to watch it again. So, okay, so we're in an uptrend now. And what does that mean? An uptrend means that we should be looking for buy positions, but not just buying at any point. For example, if this has started to turn now, then it is retracing within an uptrend. So the general direction is up, but the shorter term, or at least immediate move impulse is to the downside. So what I want to do then is, this is now a waiting period. I'm now looking for a potential turning point. Then I can look for opportunities to join that trend. And so when we're looking at a trend, I'll use an uptrend as an example. We have these extensions and retracements and extensions. And generally speaking, the very last place we want to join is on a breakout of a new high. So every time we just break above a new high, that's the last legitimate entry place for a professional trader. And a professional trader is any trader who decides to behave professionally with some experience. So in other words, anyone who decides to do that is by definition. You're a writer as soon as you start writing a book. You might not be a good one, you might be a new trader, a new writer, but that's the point. So the very last point at which we want to join a trend is on a breakout, is after breaking to new high. The earliest point at which we can join a trend is usually during a retracement, which means that actually the most legitimate entries to join a trend would be somewhere in this area. That's the last point. And then while we're busy pulling back, it would be anywhere in this area. All of those would qualify as potential legitimate entry places to join a trend. The inverse of that, in other words, all of these places would then represent the worst times to join the market. So when you start trying to join it here, you're chasing the market's going and now you're afraid, you waited too long, so you chase it, and now you're out of sync with the market. So in other words, you're always going to be out of sync with it. We want to avoid doing that. Excuse me, we want to focus on these parts of the move. Okay, these parts of the move. And so right now, technically speaking, on this time frame, we're in this part of the move. We've just had that little bit of a pullback. So we really want to find out where it's gonna find a bit of support and keep going. Generally, it looks pretty good. Let's clear this up. And let's also, and this is important because the whole point of today's thing was to talk about what are the differences right now, what's going on. I wanted to highlight these different areas. There's an area here that's clearly a selling point. This level here is clearly a selling point, and you could even argue you might even be able to argue that this area here is a little bit of a selling point. These at least are the three areas, the bands that we just can't seem to get through. So here we get through that, and then we get knocked back here, and then we sort of get knocked back here, but you can see there's a reaction where price is able, the third time round, it's able to hold a bit more at this area. And then it's able to break through there, but now it's stuck again at this area. So it's battling its way through these different areas. So what's most likely going to happen, there's not an unlimited number of ways in which this can unfold. This is the beauty. People will tell you there's a million different ways to trade the markets, which there isn't. There's a lot, but there's not a million. There's not an unlimited number. There's probably a few hundred or a few thousand. And again, there's only a few things the market can do. So for example, if I just draw a line here, so this line here is not, although it is called the trend line, I want to just use it as a compass line. As long as we stay above this line, we are generally bullish. Once we start to dip below that line, the momentum is actually starting to shift. So what I mean by that is, when a market is not really going anywhere, when a market's in a bit of a coma, it sort of goes sideways. Then it starts to break out and it starts to trend. So if it's trending at this angle, it's bullish, it's nice. If it starts accelerating and starts to trend at a steeper angle, when it starts to shift like that, we call that parabolic. So the angle at which the market is moving is also an indication of its kind of health and its strength. So if you look at this, that's a very nice, very strong move. This one here is not as strong. It's also very choppy as it goes. The smoother it is, the less choppiness, like this is just a mess over here. That's just a mess. This is relatively strong. That's a nice angle. It's almost 45 degrees down. And so when we look at this over here, at this type of angle over here, that angle stayed that way until we started to dip below it in this area. And that was the first clue that that was not going to keep going. As soon as we broke through that trend line, so let me demonstrate it in a slightly better way. So let's just say we drew, I actually don't want to do it this way. I want to do a different one. Let's just go like this. And let's just do it like this. We'll just do that. So actually here, so at this point, the angle of price staying above this line, and then it dips below it here, and then it tries to go up, and then it dips back below it, and now it just can't seem to get back up above that level. What's happened now clearly is that this bullishness is gone, and now it's shifting in something else. And actually what had happened, if you were following it, is you're in an uptrend, and then you've gone into a bit of a downtrend, you've broken the trend line, now you're going sideways. And then it tries to go up again, and then it goes straight down again, and now it's going up again and it's going down. But that trend line was a clue. And again, if we break through this, if we start to break through this, then we're going to go into a new phase, whether it's sideways or whether it's a downtrend. But for now, as long as it stays above that level, it is bullish. And that means if a market is bullish, hear what I'm about to say, please. If the market is bullish, we should see more bullish signs. So we should see nice green candles start to form. And the sweet spot for that is going to be this area here. It's going to do it, this area here. Which means, as I said to you, there's only a few things the market can do. If it's going to ultimately break out, this is a really good place for it to turn. If it's going to do that. If it is bullish and the sellers are not as strong anymore, it's going to hold at this level. Could it come down here? Yes, it could come down here in the next week or in the next month, and then recover and go from it. So that's two things that it can do if it's going to stay bullish. That's it. The only other thing it can most likely do is if it falls through here. If it falls through here or falls through here in any of this area, then we have to reassess, because then it's got to hold at this level, especially if it falls through this level. If it falls through this level, it's sitting here. And what you can deduce, so I know that sounds obvious, but what you can deduce is that if it falls through this level here, let me clear this up a bit. So option one is it's bullish and it turns here, which means we will find nice bullish candles here with lots of little wicks underneath, probably nice green candles there in the coming months, or a nice green candle off here that closes up here. All of those support the idea that in the longer term, or at least the medium term, it's going to carry on up. The next option, plan B, is that it drops down. So we get a red candle that comes down here. It manages to recover, so we get a green candle here, and then the same thing happens. So the only difference is that the first plan A happens here at that level, and the second one happens in this area over here. Those are the most likely ways in which it's going to turn around and go up if it is ultimately going to carry on long. So as a trader, what we're doing is we're not worried about where gold is going to be 6 months from now, because if gold is trending down 6 months from now, we'll be selling as a trader, not as an investor, as a trader. And if it's up here, we'll be buying as a trader. So that's why we only really have to watch what's going to happen in this area, because two of those, so I know there's really probably three things that will happen, and two of them, one is that it'll bounce here, the other is that it'll bounce here, and the third is that it'll fall through, which means that there's a 60% or 2 in 3 chance it's going to turn around. And therefore, what would I expect it to do? What would I expect to see here? I'd expect to see green candles, nice bullish reactions at those levels. If it falls through here, this is an interesting level to watch, because technically this isn't, now let me explain what the third option is. So this area is an interesting level to watch, because if we have an uptrend, the uptrend is intact so long as we don't break these lows. So even if price comes all the way down here, all the way, and holds at that level and carries on up, that is still intact. That uptrend is still intact, which means the price can still come down to this level and carry on up. But in so doing, in so breaking through that trend line, the momentum has gone from being very nice and bullish to actually not so bullish. It actually immediately tells you that the coming months are not going to be as strong necessarily. It's not going to be as strong. It's probably going to keep going for a little bit longer. So that's quite interesting to me. If we fall through the trend line, if we fall through this trend line, we're probably going to go sideways to down over the coming year, for example. But if we turn here and we turn here, we're probably going to keep going up. Okay, but it's because of what happens next. Everything is cause and effect. As soon as we break through this, the people who are bullish on gold start to panic. And either they cover their positions or they try to temporarily hedge or go short. Other people who are bearish start to add to their positions. And so it becomes it's like a snowball. Ends up gaining weight the other way. Starts doing that. Is everyone with me so far? Does this make sense? Let's have a look at the chat. Okay. Okay, so that was the earlier stuff there. There we go. All right. So that's why we have to kind of wait and see. You don't always have to do it, but you have to do it now with gold because of all these different levels. Because of the area it's at, there's lots of sellers in these areas, and it's got a bit of a bumpy road ahead of it. And therefore, you have to kind of make a plan for this level, make a plan for this level, and make a plan for this level, and so on. In principle, I'm still bullish on gold. If we get a weaker dollar, that will boost gold. Is it possible to get strong, is it possible that, this is a question for you guys, is it possible that gold can strengthen and the dollar can strengthen? Is it possible that the euro can strengthen and the pound can strengthen and and the dollar can strengthen? Is it possible? Can the EU economy do well and the US economy? And the short answer is yes. Can gold be in demand during a booming economy? Yes, it can. So you can have a strong dollar, a strong equity market, and you can have a strong euro and a strong pound. All of those things can be strong. The thing is that one will strengthen against the other. So if the dollar is strengthening faster than the euro, you'll see euro dollar go down. So you still get a relative thing, but they can all do it. So that's another kind of idea that I need to break people's brains. One doesn't have to do well at the expense of the other. Lots of things, you can have a booming economy, which means that you can, you can see a lot of this happening. So also just quickly take a very quick 2-second break here to show you this. So it's been a very, it's been a very profitable kind of month at the moment. This is one of my accounts, 12.1. Have we banked any more today? No. Okay, so we're at 12.1 for Feb 21, one of my best months in the last few years. Just did incredibly well. And the reason why was I had some open trades from November and December. I had some open trades from there. So some of the losses happened. I also trimmed. It's quite interesting how much this sort of overlays over this period. Trimmed a little bit here to, I had margin because it's a 30-to-1 account. And so if you just even have like 10 lots in open trade, you kind of trim that. So that one is trimmed. And actually then what happened was banks had a normal month in January, but an extra good month from November, December trades that carried on over. Because for the 4 weeks, last 2 weeks of December, first 2 weeks of January, nothing happened. So that's a whole, so you only get November and a bit of December and a bit of Jan, and then got those results. So very, very nice. And I think February, touch wood, will end at about close to 20 as well. I hope. We've got 10 days left. We'll have to see how that goes. A big chunk of that also on gold. So got some nice buy gold positions. So if this is going to turn around in this area, which we have actually worked out, as crazy as it sounds, there is at least a 50 to 60% to 66% chance, 2 and 3, that is actually going to happen. And there's lots of other stuff. The longer term trend seems nice and bullish. We're in an uptrend here. We're currently retracing. So what else happens? Well, we could look. Let's look at a Fibonacci retracement from this low to here. And nothing, it just tells us 50 fib is there, 618 is here. So that 618 is there. Okay, let's go and see if there's another. Okay, there we go. Okay, you were just going to mess with them. I'll make sure I finish on time. So we do it all in one recording, and I apologize for anyone who got bumped out of that. We'll try and arrange that we have the full hour usually. Okay, so all I wanted to do here was highlight what is it that I'm looking for to see in this area if price is going to turn around. So what would we're on the monthly now, what would I expect to see if we do that? Also just highlighting that this would be a 382 area. So there's lots of fib levels where there could be some support. Let's go down to the weekly and let's talk about what we'd like to see in this area. So I'd like to see some nice bullish candles, nice wicks, any kind of green candles like this would be really good. We could have a scenario which is similar to what we're seeing here, which this one here where price came down, bounced. So we had this, and then we had a second bounce off that same level, and it took off. So we could have something like that happens, comes down, bounces, and then goes up. That can happen. And so I want to be watching this area right now, because if it falls through here, if it falls through this area, we're going to come down into this area, and then I want to look for that bounce there. I think we have a good chance at it potentially turning around. So what would have to happen? Well, we look at the weekly now. The weekly is actually in a downtrend. So the weekly is in a downtrend. It's gone from this high to this low, to this lower high, to this lower low, which also means the daily is in a downtrend. So one of the things that would happen if we are turning around this area is we would start to see a change in trend on the lower time frames, certainly on the 4 hour. Certainly on the 4 hour, maybe on the daily. So let's go look at the daily. Let's see what's going on. So in the daily here, it's starting to look a little bit nice and bullish here. Okay. One of the things that I want you to take note of is that we have started to break through that. So this area price hit this and hit this, we've breached it. So what does that mean? It means we are potentially turning around where we are now. The market could do this. We're still in the daily, but it's showing you what price is doing. Price could do this though, could do that and then go. But what it has already shown us, because you can see, I'll go to the 4 hour and show you this, but it has already started to change its angle of downward momentum, it's now starting to look, it's starting to breach that area. So let's go look at the 4 hour. So I could show you this in more detail. And let's just reduce it a bit like this so you can see it. So here, you can see the 4 hour. We've got a high over here, and we've got a series of lower highs in this area over here. And if I just draw the line from that, it's not really important, just in this area, you can see we've started to breach upward through that. So you're going, well, maybe that's just a temporary breach. That's fine. Then let's adjust the line like this. But if tomorrow, which is probably what's going to happen, if tomorrow the line breaches again, then at some point you have to accept that and you can see here, it's actually doing higher lows and higher highs. The momentum has gone from lower highs and lower lows to higher lows, highs. The momentum has shifted bullish. So I think we are potentially now already seeing that shift. And it's in the right area. It makes sense. This was the level of support we were looking at. This is kind of what we're looking for. So we're already starting to see gold starting to turn bullish, but I want to see it follow through. And once it starts to do that, I can start to look for, I can start to look for trading opportunities. So how would I do that? Well, I'd go down 1 hour or 4 hour and start to look for that. So it's in an uptrend at the moment. If it breaches this, one of the ways in which I can do that, relatively simple, is look for a break and a retest of these highs here. The beauty of this is it does two things at the same time. If price breaks this downward sloping trend line and breaks this line, it does two bullish actions in the same go. And often what it'll do at that time is come back and retest this and go up, which means that the very first opportunity to go long will be here. The next one would probably be at a breakout of that level. Remember, we have a pullback or a breakout. And the next major level is up here, which means we get a relatively good first trading opportunity. Because we don't have to trade everything all the way, because then we're jumping between investing and trading. Here we're going to be looking for a single trading opportunity, entry here or here, and close the trade out here. Then wait for a break and a retest, re-enter if we get a setup there. Trading doesn't assume that the trend is going to run forever. Trading assumes the move is going to be short-lived. You get your money, you get out. If the trend looks good, you can either take partial profits and leave a bit in, or you take a new trade and you get back in. And the beauty of that is you're compounding now because your new balance is higher. So now you get back in on a higher balance and you're compounding. So that is the point of that. And I think that is actually it. That's all I really needed to say on this. So we've spoken about what we expect it to do. It looks as though it's already trying to turn around. We've spoken about what we'd expect to see tomorrow. And I've spoken about the very, very first trading opportunities that we could get in between where we are now and where we are then. And obviously in the next webinar that I do, I'll have a look at where gold has moved since today's webinar. And obviously I have here the 26th is the very next one that we will do, which is next Monday. It's a week from today. So we can see where gold is a week from today. Just one more thing I want to show you here, which also supports the idea, is if we very quickly go ahead and take a look at silver. I don't often do this, but silver is looking very interesting. From a monthly perspective, silver has produced a bullish engulfing candle. Bullish engulfing off a level of support. It's also stuck in a range. So if you kind of grab this, that's a bit of a range. There's the bottom of the range. There's the top of the range. It's at the bottom of the range producing another bullish rejection and a bullish engulfing candle. So that's a bullish within a range. That's a relatively bullish setup. And when we're looking from a daily perspective, what happens is it does appear as though it's broken down. It's potentially looking to come back and test this level of support in this kind of area here. So sort of come back, test the support, we'll see, and then possibly start to take off tomorrow and start to head a little bit higher. And if it does that, then it makes sense that gold is also climbing higher. So I don't always do this. I'm saying that it's unusual, but there's bullish signals showing up in silver. And I think there's a possibility that also supports the idea that gold's going to go higher. And that is it from me. So I was going to say the next step, ladies and gentlemen, is to get you to register and join me, please, for the Monday the 26th, which is next week. I'll be promoting that anyway on Friday and on Monday again. And I want you to please come and join me. And the topic that we'll be talking about on Monday next week, aside from checking this out, is I'll be talking about risk management for day traders. So I want to talk about how we kind of, what I've discussed here a little bit here is with smaller accounts. So if you've got $500 or 1,000 or 5,000 in your account, those are smaller accounts, how we can talk about calculating risk management for that. And actually, even with $1,000 in your account, it is still possible to trade the daily chart. A lot of people don't think so, but it really is. As long as you can place micro lots and mini lots, as long as you can do that, you can place those larger trade setups. And then I want to talk about trader psychology and obviously techniques as well. So that is it from me, at least from today's topic.
Well, I think you did really, really well. Excellent analyst. Yeah. Hopefully, I hope as many people as possible join our next webinar. Okay. So could you just please explain briefly to the people the different topics that you're gonna cover in the next webinar?
So yeah, so the next Monday, I'll be talking about risk management. So today I want to talk about a bit of technical analysis and looking for setups. And then next week I want to talk about, okay, so once you find a setup, how do you calculate your risk around that? Because I've identified, for example, we've identified 3 ways in which gold will probably play out over the next few weeks. And there's 2, it has a greater chance of going up than going down because we've looked at the probabilities. But we also need to apply that to our risk. It's not guaranteed. So trading isn't guaranteed. And that actually impacts our mindset. So how much we risk impacts our trader mindset and our confidence and our psychology and our behavior. If we risk too much, we can panic and then we start moving our stop loss, then we start revenge trading and we do crazy stuff, all because all of that crazy behavior comes back down to the one thing we did, which was either that we didn't calculate our stop loss correctly or we risked too much. So trader mindset is tied into where we decide to put our stop loss and why we're taking the trade. And some trades have lower risk. The probability of success is much higher. So sometimes there's 10 things that tell you this is going to be a very strong trade. And therefore the probability of it moving at least 2 to 1 or 3 to 1 maybe is very high. But other trades don't look as strong. They look more bullish than bearish, but they also have a couple of red flags. And so you still want to take the trade, but maybe you want to risk less or you want to take profit sooner. And all of that is tied to your mindset. So that's what we're going to talk about with risk management for day traders. And then in March, we're going to talk about the best charts to trade in March, which means I'm going to run through all the different asset classes like we did today with gold, but I'm going to look at crude oil, I'm going to look at currencies, I'm going to look at the indices, I'm going to look at equities, and I'm going to talk about which ones have the best trends in them and which ones are ripe for the taking. In other words, which ones can we look for trades in the next few days, which ones are things we might have to wait a week or so before those entries arrive, how we create a watch list. So those are all the different things that I can do in that in the last one, which is at least in the last one of this series.
Excellent. So yeah, it's better to choose the right scenario instead of taking all the trades. You try to take all the opportunities. At the end, you have to evaluate the risk versus the reward, no ratio risk benefit. Yeah, so it's good. Adam, it was a really pleasure to have
thank you very much
this collaboration with you. Hopefully, yes. So the next one is coming on the 26th. I would say at the same time, 8 p.m. Central European Time, 7 UK. Correct? Yes.
Yeah.
Excellent, Adam. Great.
So thank you very much. I'm going to say goodbye. Thank you, everyone, and I look forward to seeing you next week. Thank you.
Thank you, Adam. Thank you.
I will provide a link. Also, we could put a link for the registration for next week's one in the description of this video when I post it on my channel anyway. Okay, so you can register if you want. All right, great.
Thank you, Adam.